Capital structure refers to how a company finances its operations and growth using a mix of debt and equity. It shows the proportion of money a business raises from borrowed funds, debt, and owner investment, equity, to support its activities. Components of capital structure. Debt borrowed money includes loans, bonds, and credit lines that the company must repay with interest. Debt financing is attractive because it allows businesses to expand without giving up ownership. However, too much debt increases financial risk due to interest payments. Equity, owner investment, comes from selling shares, stocks, or retained earnings, profits reinvested in the business. Equity financing reduces financial risk since there are no required repayments, but it dilutes ownership. Hybrid instruments. Some companies use convertible bonds or preferred stock, which have features of both debt and equity. Why is capital structure important? Impacts financial stability. A well-balanced structure ensures a company can handle debt repayments while maintaining growth. Affects profitability. Too much debt can lead to high interest costs, reducing profits. Too much equity can dilute ownership. Determines risk level. Companies with high debt are more vulnerable in economic downturns. Influences investor confidence. Investors prefer companies with a stable and efficient mix of debt and equity. Types of capital structures. Debt-heavy capital structure. The company relies more on loans and bonds. Advantage. Lower cost of capital because interest payments are tax-deductible. Disadvantage. Higher risk due to fixed debt payments. Equity-heavy capital structure. The company raises funds mostly from shareholders. Advantage. No debt repayments, reducing financial risk. Disadvantage. Profit sharing with investors and potential loss of control. Balanced capital structure. A mix of debt and equity to optimize growth while managing risks. Many companies aim for a balance to maximize benefits from both sources. Example of capital structure in action. A company needs $1 million to expand. It can borrow $600,000 from a bank debt. Raise $400,000 by selling company shares, equity. This gives the company a 60% debt and 40% equity capital structure. If the company grows and profits, debt financing benefits shareholders because profits are not shared with lenders. However, if profits decline, high debt payments can strain the company. How companies optimize capital structure. Balancing risk and return. Finding the right mix of debt and equity to maximize profits while managing financial risk. Using debt strategically. Companies with stable cash flow may use more debt to benefit from tax deductions. Raising equity when necessary. Startups and growing firms may prefer equity financing to avoid high-interest debt. Quick recap. What is capital structure? The mix of debt and equity a company uses to fund its operations. Why is it important? It affects financial stability, profitability, risk, and investor confidence. What are the key types? Debt-heavy, high-risk, low-cost. Equity-heavy, low-risk, diluted ownership, and balanced structures. A company's capital structure is crucial for long-term growth and financial health, influencing everything from profitability to business expansion.